Louis, I just want to pick up on a comment you made, which is calling a spade and saying that we could see a financial crisis. I don't think anybody is talking about that or thinking about that because we've had it in the past and it feels so present, like that we've just experienced it. Um, if anything, I've heard people more worried about a sovereign debt crisis. So how do you explain this?
Um, I explain this simply by the fact that banks are acting very and looking very sick. Um, bank shares are for me a key leading indicator, and there's really only two markets where bank shares are clearly lagging. It's Canada and the US.
Mm,
Um,
hmm,
and I think this reflects a simple reality. First, they're loaded with bonds on that are not marked at the right price in their books, and secondly, uh, we have a bonds have adjusted, of course, to the fact that we're now going to see higher structural interest rates. Real estate prices haven't yet. And whenever you get big adjustment on real estate prices, all too often banks end up being hold bag holders. People mail the keys to the banks. Now, the legal structure allows this to happen more frequently in the U.S. than in Canada, but
right.
I think real estate is a real issue going forward, and the extent to which banks are exposed to it is a big question mark.
Hmm. Some people would say, well, and many strategists are expecting that the U.S. Federal Reserve and maybe Canada as well will actually end up lowering interest rates. You would think that that would alleviate some of the pressure on the banks as well as the housing market. And I want to get to the housing market as well.
Oh, look, the central bank has three mandates. We've all learned at school that they've got inflation and they've got growth as a mandate. Since 2009, the Fed has been told you're also responsible for managing the banks, for regulating the banks, and making sure that we don't have any more banks going bust. So, yes, I would definitely expect that as banks get into trouble, the Fed will cut interest rates because the easiest thing to do when banks hit trouble is to put in a steep yield curve for the banks to basically recapitalize themselves. So
Yeah.
yeah, as banks hit the wall, central banks will do what they always do: cut interest rates, put in a steep yield curve, and basically pass the brunt of the adjustment from the bond market to the currency markets. As they cut interest rates, the U.S. dollar will take a big hit because U.S. dollar has been very well decent, actually not that even that strong, but decently strong in recent years, simply on the
Hmm.
back of rising interest rates. You've had
Right.
absolutely no fiscal adjustment in the U.S. You've had, it's people have all clambered in there because the U.S. offered the highest interest rates. You take that away, and the U.S. dollar will go down pretty meaningfully.
Hmm. What are you seeing, just speaking of housing right now? And it's been so interesting to watch the housing market, both in Canada as well as the United States, on the back of higher interest rates. It's almost as though it's really frozen people into their homes because they don't want to go out there and get another mortgage at a higher rate. So, what kind of impact are you seeing that have in Canada?
I think the effect of that is going to be stronger in the U.S. because in the U.S. you really have the ability to lock in 30-year mortgages, right? And a lot of people have. 60% of Americans pay less than 4% on their mortgage. This isn't the case in Canada. So in Canada, the hit of higher interest rates, most households are now by now feeling the hit of higher interest rates, or they likely will in the next 18 months or so, as all the mortgages start to roll. So the consumption hit of the higher interest rates, of the higher mortgage rates in Canada should likely be greater than it is in the US.
And when do you see, or how do you see that impacting the Canadian economy? I mean, it seems as though we're essentially flat as it relates to growth. And interestingly to me, former Bank of Canada Governor Stephen Poloz is talking about stagflation. What does
Yeah,
that mean to people?
I think Canada will end up being saved like it always is by a combination of a weak currency and perhaps decently high commodity prices. Um, and you do have that get out of jail free card. Today, what I think people are underestimating is the extent of the boom that is already starting across non-Chinese emerging markets. When you look at things like iron ore prices, energy prices, everybody's scratching their head as to why these things have held up in the face of a China slowdown. the reality is India's booming, Indonesia's booming, Latin America's booming, the Middle East is booming, and all these countries are going through massive infrastructure spending booms. So, you know, high commodity prices will once again bail out Canada. So it'll be okay.
Okay, interesting. And I think that's why you have an interest in some of those emerging markets and setting up a new debt fund. We'll get to that right after the break. We'll be right back.